For this style of task, we're looking to identify any future, incremental cash flows. That's another way of saying we're looking for relevant costs. So we'll need to check for each of the items in the list whether they meet all three criteria. Is it future? Is it taking place at some point in the future? Incremental, in other words, changing as a result of the decision? And is it a genuine cash flow? We don't want to allow any non-cash items to be included in our calculation. The first item in our list is the initial investment, and that's a regular figure we'd expect to see included in an NPV calculation. $450,000 is only going to be spent on this new equipment if we go ahead with the project. So that's certainly something we can include as relevant. The next item, though, depreciation, looks like it's not going to meet our criteria. We said future incremental cash flows. Well, depreciation is a non-cash item, so on that basis, we'd need to exclude it. The staff training costs of $20,000. Well, let's have a look at the exact situation. We'll look at the wording for our training costs. So we can see a further $20,000 would be spent on the training, the rest of the gym staff, if the equipment is purchased. Well, we're only going to incur this cash flow then if we go ahead with the project. So it sounds like it's definitely incremental, it's certainly a cash flow, and it hasn't happened yet, so we can class that as a future cash flow. Next, we're asked about our temporary manager's salary. Well, we might think that that's a separate manager who's going to be employed, in which case we could well include that. But if we look at the wording of this task again, we can identify if it meets our three criteria. So it looks like an existing manager is going to be asked to cover the running of the centre for 1 month. We can see certainly 48,000 divided by 12 months would get us to the 4,000 figure in the question. However, we're told that they're not going to be replaced at the other centre during this month. We're not incurring any additional cash flows then compared to our normal operations. This is an annual salary that would be incurred regardless of whether we go ahead with the new project. Therefore, it doesn't meet the incremental criteria. With the conference training costs, we're told that $3,000 is money that's already been spent. So it doesn't meet the future criteria, it's what's known as a sunk cost. With the interest of $6,000, this is a common one to come up in the exam. The key thing to remember is that when we discount our cash flows, we're going to do so at the cost of capital. Cost of capital includes my cost of equity and my cost of debt. Okay, at this level we don't need to understand in detail how it's calculated, but we do need to recognise that the cost of debt has already been included in that discounting. So if I were to include the interest cost as well as discounting my cash flows, then I would effectively be double counting the cost of debt, which is why, despite the fact that it seems to meet the criteria of being a future incremental cash flow, it's one that we don't include as a specific line of cash flow because it's already been included in that discount factor at the end of our calculation. Next, we're asked for the incremental sales in year 1. We're told at the moment sales are $500,000 and we're expecting that to rise to $550,000 in year 1 if we go ahead with the changes. However, we're also told that if we don't proceed, we'd expect next year our sales to drop to 40,000. So let's make the comparison. With the new equipment, we'll be looking at 550,000, and without it, it'll be 500 less a decrease of 40, so we're looking at 460. So I can see the difference between the two. The incremental sales revenue would be 90,000. Next, we can consider the value of those maintenance costs. We're told maintenance is going to be 10,000 per annum, and that's going to be for a 5-year period. However, we can't simply multiply it by 5 years because we need to recognise the time value of money. So we'll need to take our cumulative discount factor for 5 years at the cost of capital, our 10%. If we look that up, we can find the cumulative discount factor comes in at 3.791, giving us then total value of those maintenance payments, 37,910. Finally, we need to find the additional electricity costs, so not the total value, but just the increment, the additional amount. We know that that's going to be 5% of our total revenue. Well, the predicted revenue with the investment will be 550,000. So that gives us a total of 27,500.